Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Hey listeners, earlier this month, we announced that the newly updated second edition of my book, Shareholder Yield, A Better Approach to Dividend Investing, was available on Amazon in print and as an ebook. Great news! We now have it for you as an audiobook and are publishing it for free right here on the podcast. You can check out the podcast show notes for the timestamps for each chapter, as well as download all of the figures in the book at shareholderyield.com. Enough from me. Enjoy the book. Shareholder Yield, A Better Approach to Dividend Investing, second edition. Published by The Idea Farm. Written and narrated by Meb Faber. Updates in the second edition. A decade has passed since the book's first edition was published in 2013. In the second edition, we update the strategy's performance over the ensuing years and extend the historical simulation another decade into the past. We even review some academic literature that examines similar portfolios back to the 1800s. You can find more information and links to resources at www.shareholderyield.com. This book is dedicated to Anton. Introduction. The Blind Men and the Elephant. It was 6 men of Indostan, to learning much inclined, who went to see the elephant, though all of them were blind, that each by observation might satisfy his mind. The first approached the elephant, and happening to fall against his broad and sturdy side, at once began to bawl, "God bless me, but the elephant is very like a wall." The second, feeling of the tusk, cried, "Ho, what have we here? So very round and smooth and sharp, to me 'tis mighty clear, the wonder of an elephant is very like a spear." The third approached the animal, and happening to take the squirming trunk within his hands, thus boldly up and spake, "I see," quoth he, "the elephant is very like a snake." The fourth reached out his eager hand, and felt about the knee. "What most this wondrous beast is like, is mighty plain," quoth he, "'tis clear enough the elephant is very like a tree." The fifth, who chanced to touch the ear, said, "E'en the blindest man can tell what this resembles most. Deny the fact who can, the marvel of an elephant is very like a fan." The sixth no sooner had begun about the beast to grope, then seizing on the swinging tail that fell within his scope, "I see," quoth he, "the elephant is very like a rope." And so these men of Indostan disputed loud and long, each in his own opinion exceeding stiff and strong, though each was partly in the right, and all were in the wrong. Moral. So often theologic wars, the disputants I ween, rail on in utter ignorance of what each other mean, and prate about an elephant not one of them has seen. John Godfrey Sax's 1868 to 1887 version of the famous Indian legend. This parable originated in India, and while different versions exist in various Buddhist, Hindu, and modern traditions, the general story remains the same. Each blind man touches a different part of the elephant and responds differently when asked to describe his feelings. In the end, the king conveys the moral that, while each opinion may represent a piece of the truth, in isolation from one another, no single perspective reveals the whole story. So what does this have to do with investing? In many cases, whether evaluating a stock or some macro influence on the economy, we must diligently seek other perspectives and consistently question what it is we are seeing. Often, only after the fact, and after much devastation to the value of a portfolio, do we realize that we only saw a small piece of the overall picture. Most research analysts focus on a company's operations, the exciting and sexy part. What new services or products are companies launching? Consider the excitement around an Apple or a Tesla new product reveal. While operations are certainly important, the role of capital allocation in the company's future success is often overlooked. A book that Warren Buffett recommends examines this understudied topic. The Outsiders, 8 Unconventional CEOs and Their Radically Rational Blueprint for Success by William Thorndike. A quote from the book. CEOs need to do 2 things well to be successful: run their operations efficiently and deploy the cash generated by those operations. Most CEOs, in the management books they write or read, focus on managing operations, which is undeniably important. Basically, CEOs have 5 essential choices for deploying capital: investing in existing operations, acquiring other businesses, paying down debt, or repurchasing stock, and 3 alternatives for raising it: tapping internal cash flow, issuing debt, or raising equity. Think of these options collectively as a toolkit. Over the long term, returns for shareholders will be determined largely by the decisions a CEO makes in choosing which tools to use and which to avoid among these various options. In fact, this role just might be the most important responsibility any CEO has, and yet, despite its importance, there are no courses in capital allocation at the top business schools. End of quote. This book exposes the reader to certain presuppositions about investing and examines overlooked capital allocation decisions that deserve closer attention. We examine how a company uses its cash flows and the resulting impact on its stock, and ponder the question concerning dividends. Is this the whole picture, or am I only holding the elephant's trunk? Chapter 1. Reinvesting dividends has worked well over time. Dividends and their reinvestment represent a major portion of a stock investor's total return over time. An examination of equity returns in the United States from 1871 illustrates this property. An investor in U.S. stocks would have realized a 9.16% compound return from 1871 to 2023. However, excluding dividends and their reinvestment would have reduced the portfolio's compound return to 4.67% per year, demonstrating that reinvested dividends represent over half of an investor's annualized returns over the period. While most investors focus myopically on stock price gyrations, dividends are the slow but steady engine that drives returns. Analyzing the final value of a portfolio invested in U.S. stocks since 1871 reinforces this view. Figure 1 demonstrates that if one had invested $100 in 1871 in the price return index, by the end of 2023, it would have compounded to $108,459, gross of fees, transaction costs, and taxes, of course. When we consider the total return portfolio, which reflects price return and dividend reinvestment, the ending value jumps to $66,691,486, a 600-fold improvement. Now, many investors fantasize about sitting on a beach, sipping pina coladas, and letting that sweet passive income stream flow in. However, this total return for stocks requires the investor to reinvest all dividends. Academic research reveals that most investors use their dividends for other purposes, like vacationing and slurping pina coladas, reducing the portfolio's total return. Now, if companies didn't pay dividends, the entire return would be reflected in the price return and should match the total return of 9.16%. But this scenario is hypothetical and not the world we live in. The takeaway is simple: reinvest your dividends if you want to realize total equity returns. While reinvested dividends have historically proven to be a major factor in determining a portfolio's final value over long periods, price movements dominate the volatility of the returns in the short term. Large price swings have enormously impacted returns from time frames ranging from 1 year all the way out to a decade. In Figure 2, it shows price returns, which are the red lines, and dividend yield, which are the blue lines, by year since 1871, and the variability of the price returns swamps the steady dividend yield returns. In Figure 3, price movements still dominate total returns even at longer time frames. Price-to-earnings ratio expansion positively impacted total returns in the 1920s and 1990s, while the reverse occurred in the 1930s and 2000s. Even the steady contribution of dividends could not prevent the equity markets from experiencing negative total returns in the 1930s and 2000s. Many investors go a step further and select stocks based on their dividend characteristics. In the next chapter, we'll examine strategies for selecting dividend stocks and their historical performance. Chapter 2. Investing in high dividend yield stocks has worked even better. While reinvested dividends contribute a major portion of stock market returns over time, research also indicates that higher yielding dividend stocks have performed better than stocks with little to no yield. Elroy Dempson, Paul Marsh, and Mike Staunton published Global Investment Returns Yearbook 2023, in which they studied U.S. stocks from 1927 to 2023. They found that the highest 30% of dividend yielders returned 11.2% versus 9.7% for low yielders and 9% for no yielders. They completed an even longer study on UK stocks. They sorted the 100 largest UK stocks from 1900 to 2023 into high and low yield portfolios and found that the compound returns were 10.4% and 7.8% per year, respectively. This is the companion study to my favorite investing book, Triumph of the Optimists. Historically, dividend stocks outperform the broad stock market likely because they provide a value tilt. This means that, on average, high-yield dividend stocks trade at a valuation discount to the broad stock market. High dividend-yielding stocks also come with some other characteristics and, on average, are junkier companies with more debt. The characteristics can wax and wane over time, but on average, high dividend-yielding stocks usually come with cheaper valuations. And perhaps equally important, narrowing stock selections to this subset of cheaper stocks, by definition, avoids investing in the more expensive stocks. Much more ink has been spilled across academic and professional publications validating similar findings that can be found on shareholderyield.com. There are countless websites and groups devoted to dividend investing. Many readers will have heard of strategies such as Dogs of the Dow or the Dividend Aristocrats. In their recent report, Searching for Great Dividend Funds, Morningstar estimates that 348 open-end mutual funds and ETFs manage over $1 trillion focused on dividend strategies. That's quattro commas for those counting at home. Investors may love dividends, and high-yielding dividend stocks have historically outperformed the market. So why are we about to slay this sacred cow? Because the world has changed. Chapter 3. Dividends are only part of the picture. Now that we've demonstrated the long-term evidence that reinvesting dividends is crucial and that investing in dividend-paying stocks has led to outperformance, we want to shift gears and caution investors not to consider dividends in isolation, contently believing the elephant to be a rope. One of the most essential qualities of a successful investment analyst is the ability to adapt to change. Far too many investors adhere to their approach with a religious zeal, whether it's value investing, crypto trading, or good old buy and hold indexing. For those investors who are proponents of investing in dividend stocks, we ask you to keep an open mind. It is very important to be cognizant of structural changes in markets. Now, while some truths seem to be inherent to the market's nature, they being highly volatile, large outliers, bubbles, booms, and crashes, others can change based on government policy updates and macro factors. Investors love to quote John Maynard Keynes, who famously stated, "When the facts change, I change my mind. What do you do, sir?" One structural change in the stock market is that companies currently pay out a lower percentage of their earnings in cash dividends than in the past. As seen in Figure 4, while companies historically pay out on average over 60% of their earnings as dividends, this figure has been declining consistently for the past 70 years and currently sits around 40%. This trend has resulted in the dividend yield on stocks declining to all-time lows in the past decade, as seen in Figure 5. You can see a red line represents the average yield over the period, which has been approximately 4.5%. The current yield of approximately 1.3% is not too far from the all-time low dividend yield of 1.1% during the dot-com bubble. When examining any fundamental shift in markets, we must analyze why the change occurred. Why are companies paying out less in cash dividends? One reason is the SEC instituting Rule 10b-18 in 1982, which provided a safe harbor for firms conducting repurchases from stock manipulation charges. A noteworthy paper on trends in corporate payout policy is Dividends, Share Repurchases, and the Substitution Hypothesis in 2002 by Groen and Michaeli. Once the government made it easier for companies to buy back their stock, buybacks became increasingly prevalent. Figure 6 details how stock buybacks went from nearly nothing to equaling or surpassing cash paid out as dividends in the late 1990s. While companies have paid out less in cash dividends when including stock buybacks, it becomes clear that the aggregate amount has stayed relatively constant. If you chose to ignore stock buybacks, you may come to incomplete conclusions by focusing on dividend alone. In Figure 7, we show the dividend yield plus buyback yield on stocks. And once you examine the combination of dividends and buybacks, then the picture shifts significantly. Rather than paying out any less aggregate cash flows to their shareholders, companies have simply changed the distribution method to include both. While it's obvious that share buybacks began outpacing dividend payments in most years beginning in the late 1990s, we need to understand why. Why might companies choose to buy back stock rather than pay out cash dividends? First, we got to pause for a moment. Stock buybacks are one of the most emotional investing topics. NYU professor Aswath Damodaran calls dividends and buybacks perhaps the most misunderstood and misplayed element of corporate finance. Even Warren Buffett has described those who oppose buybacks as economic illiterates and silver-tongued demagogues. Before we move on, let's take some time to understand exactly what stock buybacks are and how they work. Chapter 4. What are stock buybacks? Professor Ken French comments that buybacks are divisive. They divide those who understand corporate finance from those that don't. Let's ensure we're all on the same page before continuing. We'll start with a simple example. Let's say you have a company worth $100. If the company pays a 10% cash dividend, it gives the shareholders $10. The shareholders now have $10 in cash in a company worth $90. Makes sense? Let's repeat with buybacks. So let's say again you have a company worth $100. If the company buys back 10% of the stock, it gives the selling shareholders $10. The selling shareholders now have $10 in cash in a company worth $90. It's the exact same thing. Now, if a stock trades at intrinsic value, then a cash dividend and a stock buyback are identical. Full stop. That is Finance 101. Many investors do not fully grasp this very basic truth. What about the shareholders who choose not to sell any stock? Post-buyback, they now own a larger percentage of the company, and we'll discuss this more in a minute. One way to test if you're biased against stock buybacks is to read a newspaper article or a quote, but every time you see the word dividend, replace it with the word buyback, or vice versa. Does it change how you feel? It shouldn't. So if there's no difference, why have share buybacks outpaced dividend payments beginning in the late 1990s? Why might companies choose to buy back stock rather than pay out cash dividends? Let's examine a few reasons. First, stock buybacks can buy $1 for 80 cents. The key difference between buybacks and dividends boils down to one phrase. What is the stock worth? No one understands stock valuation and capital allocation better than Warren Buffett. Berkshire Hathaway only paid a dividend once in its history in 1967, and Buffett famously said that he must have been in the bathroom when the dividend was declared. When asked in 1998 about paying another dividend in the future, Buffett responded to the audience at the University of Florida, "The question is about evaluating Berkshire when it doesn't pay any dividends, and it won't pay any dividends either. That's a promise I can keep. All you get with Berkshire stock is that you can stick it in your safe deposit box, and every year you take it out and fondle it." Presumably, Buffett believes that he has better capital allocation skills and investment opportunities than returning money to shareholders through dividends, and he has remained true to his word. In times when the underlying stock trades at a discount to intrinsic value, buybacks are a favorable use of cash. Buffett penned in a 1984 letter to shareholders, "When companies with outstanding businesses and comfortable financial positions find their shares selling far below intrinsic value in the marketplace, no alternative action can benefit shareholders as surely as repurchases." This insightful quote is particularly impressive when you note it was from 40 years ago. One more recent quote, this time in the 2023 Berkshire Annual Report, reads as, "All stock repurchases should be price dependent. What is sensible at a discount to business value becomes stupid if done at a premium." Warren's late partner Charlie Munger was also a fan of buybacks. In his typical witty fashion, Munger advised investors to look for the cannibals, meaning companies eating themselves with a consistently declining share count. While Berkshire has avoided paying dividends, Warren and Charlie have bought back boatloads of stocks over the years. CNBC recently reported in the summer of 2024 that over the past 5.5 years, or 22 quarters, Berkshire has repurchased nearly $75 billion worth of its common stock, eliminating more than 10% of the company's total shares outstanding, according to Gregory Warren, Berkshire analyst at Morningstar. Buffett shared more thoughts on stock buybacks in his 2021 annual letter to shareholders, writing, "Through that simple act, we increase your share of the many controlled and non-controlled businesses Berkshire owns. When the price-to-value equation is right, this path is the easiest and most certain way for us to increase your wealth." The entire discussion of stock buybacks would be easier if this stock fair value metric was known with certainty. If you could say that one stock is 50% undervalued and another is 150% overvalued, the debate would be simple. For a moment, let's assume we can tell an overvalued stock from an undervalued one with reasonable confidence. If a company buys back shares and the stock is overvalued, the company and the remaining shareholders transfer value to the selling shareholder. If the stock is undervalued, the person selling shares transfers value to the company and the remaining shareholders. Warren Buffett has a better way of saying it in his 2021 letter to shareholders. Indeed, disciplined repurchases are the surest way to use funds intelligently. It's hard to go wrong when you're buying dollar bills for 80 cents or less. We believe a great CEO should do the opposite as well. If they believe their stock is wildly overvalued, they should consider issuing shares to the market. They should consider buying shares if they believe their stock is a screaming bargain. Surprisingly to many, it turns out that's exactly what CEOs do on average. They're pretty good at valuing their company and acting in their own best interest. For example, Buffett has a good objective process. He originally stated that he would buy back stock if Berkshire traded below intrinsic value, which he measured at around 1.1 to 1.2 times book value. A quantitative, systematic process is preferable to a megalomaniac CEO who always believes their stock is cheap. We'll cover this in more detail in an upcoming chapter. Returning to our conversation about why share buybacks have outpaced dividend payments in recent years, another reason is taxes. Stock buybacks are tax-efficient dividends. Hypothetically, investors shouldn't care whether their returns come from dividends or capital gains, otherwise known as the Modigliani-Miller theorem. This approach assumes a tax-neutral investor, when, in reality, most investors are highly sensitive to tax treatment. While tax rates fluctuate with the political seasons, it has often been the case that dividends taxed as ordinary income have had inferior tax treatment to long-term capital gains that historically carry lower rates. If you're a shareholder and love the business and the stock, The last thing you want is for the company to return your money. Even worse than that is the company giving you your money back and having to pay taxes on the dividend. This is one reason that Demoteran has stated you could rebrand buybacks as tax-efficient dividends. In about half of the past 50 years, dividends have been taxed at higher rates than the long-term capital gains, apart from 1988 to 1997 and 2003 to the present. While this disadvantage was improved by the Bush tax cuts in the 2013 update, and while some foreign countries do not have inferior tax treatments for dividends, the number of companies paying dividends has nonetheless declined from nearly all to around 30%. A paper by Jacob and Jacob in 2011 called Taxation, Dividends, and Share Repurchases, Taking Evidence Global, examines 6,416 companies across 25 countries and finds that relative tax rates are hugely important. They state, our results show that dividend and shareholder taxation are important determinants of corporate payout internationally in the past 20 years. In countries and years where dividends are taxed favorably relative to capital gains, firms are more likely to pay dividends and the amount of dividends is greater. Conversely, in countries and years in which capital gains receive preferential tax treatment over dividends, firms are more likely to repurchase shares to pay out cash to investors. Another concise summary of dividend-paying stocks is the 2001 French and Fama paper, Disappearing Dividends, Changing Firm Characteristics or Lower Propensity to Pay. However, both cash dividends and stock buybacks are taxed multiple times. Cash dividends are taxed when the company makes a profit, then when the cash dividend is issued, plus the 3.8% Medicare tax. Buybacks are taxed when the company makes a profit, then when the buyback is made, as a shareholder is selling the stock, plus the 1% surcharge buyback tax, plus the 3.8% Medicare tax. They're both often taxed at the state level too. Uncle Sam will not be denied. In general, investors want to avoid paying taxes if they can. Stock buybacks give investors that choice. Stock buybacks are also flexible dividends. In our previous example, the investor received a $10 cash dividend whether they wanted to or not. If the investor liked the stock, which is a safe assumption given ownership, he or she would most likely reinvest the dividend after paying Uncle Sam. This would be annoying at best and a value destroyer at worst. However, if the company were instead doing a share buyback, the investor would have the choice to take the payout. The investor will receive the same $10 as the cash dividend investor if they sell the stock, but if they like the stock, they don't have to sell and instead increase their ownership stake. The key is choosing when to take the cash. For taxable investors, this matters. If a company never pays a cash dividend or buys back stock, investors can always create their own synthetic dividend by selling the same percentage of the stock, in this case, 10%. Dividends tend to be steady from year to year, whereas buybacks on aggregate bounce around a lot and are about 5 times more volatile. Cutting or eliminating a dividend is seen as a signal to investors that all is not right at corporate headquarters. CEOs can be more tactical with stock buybacks. Stock buybacks also neutralize options dilution. Another reason CEOs buy back stock is to reduce the dilution from options issuance. In his book, Stock Buybacks, The True Story, Ed Yardeni speculates that most stock buybacks are intended to offset the dilution from employees exercising their stock options. This pushes back against the anti-buyback narrative, suggesting that buybacks are engineering intended to artificially inflate a stock price, and we'll get more on that in the next chapter. Yardeni suggests that most buybacks by S&P 500 companies are intended not to goose earnings per share for optics, but to offset this type of employee compensation. As such, these buybacks are an effective way to retain top talent for the company while maintaining a stable earnings per share number that isn't artificially lowered by the stock issuance. In this discussion, it's important to recognize how employee compensation packages have increasingly included stock options over the last 20 years. A 2023 paper from Morgan Stanley titled Stock-Based Compensation: Unpacking the Issues concluded, public companies in the U.S. have increasingly switched from paying their employees in cash to paying them with stock. Stock-based compensation in 2022 was nearly 5 times what it was in 2006, measured as a percentage of sales, although total stock-based compensation remains less than 10% of total employee pay. There are sensible motivations for this shift. Stock-based compensation helps finance the firm by substituting equity for cash, can provide an incentive for employees to deliver results, is a tool for retaining workers, and can be a means to foster an overall sense of ownership. Companies can use stock-based compensation appropriately or inappropriately, as it is true of all capital allocation decisions. Meanwhile, in his 2024 paper, Which One Is It?, Michael Malbison writes, stock-based compensation has been the second largest source of equity issuance in the last quarter century. As a percentage of sales for companies in the Russell 3000, an index that measures the performance of roughly 3,000 U.S. stocks and represents nearly all the investable equity market, it went from 0.2 of sales in 2006 to 1.3 of sales in 2023. The compound annual growth rate was 15.3% for stock-based compensation and 3.8% for sales. The dollar sum of stock-based compensation rose from $26 billion in 2006 to $290 billion in 2023. Through this lens, share buybacks can effectively balance the shifting landscape of corporate culture, shareholder interests, and a dynamic labor market in which competition for top talent is fierce and stock-based compensation is often expected. Stock buybacks can help prevent bad behavior. Quick question. What do you do with the dividend income you receive? Do you spend it on vacations and travel? Or perhaps you view it as a supplemental income to your day job? As mentioned previously, the historical long-term average of roughly 10% per year stock returns are only realized if you reinvest your dividends. Academic research shows that an average individual does not reinvest their dividends. One benefit of buybacks is that they are golden handcuffs for mom and pop investors, potentially keeping more money invested. It's a lot harder to actively sell an investment to generate cash than it is to receive an automatic dividend. And it's a lot easier to spend money in the bank if it's there in the first place. Now that we've defined stock buybacks and discussed why they become popular with corporate managers in recent decades, let's clear up some confusion and popular myths. Chapter 5. Common Buyback Misconceptions. Over the last decade, criticisms against share buybacks have intensified. It's understandable. The broad public largely misunderstands share buybacks, so they're an easy lightning rod for politicians, journalists, and investment gurus who benefit from a us versus them dichotomy. But how many of these are true or rooted in truth compared to those that are purely myth? Here we examine a handful of the most common buyback myths. Let's take some time to walk through them and find out. Myth 1. Buybacks were illegal before the 1980s. Here's California Congressman Ro Khanna. Prior to 1982, stock buybacks were considered illegal stock manipulation, but President Reagan's Securities and Exchange Commission implemented a rule to exempt them. It's time to put a stop to this greed. The idea that corporate stock buybacks were illegal before the SEC's Safe Harbor Rule 10b-18 in 1982 is a popular myth, yet it's wholly inaccurate. As Jason Zweig wrote in the Wall Street Journal, to call this argument baloney would be an insult to cold cuts. When American companies began repurchasing shares from their investors, Alexander Hamilton was Treasury Secretary, and corporations have been buying back stock, often a little, and sometimes a lot, ever since. Zweig walks through examples showing how share buybacks have dotted the American corporate landscape for 200 plus years. As one illustration, in 1798, the Pennsylvania legislature granted a corporate charter to the Germantown and Reading Turnpike Road Company based on the condition that the company would buy back as many shares of its stock as possible if profits remained after a 9% annual dividend. In the late 18th and early 19th centuries, stock buybacks weren't just legal, they were required in some cases. As Zweig explains, mandatory stock buybacks appear to have been intended to keep management from pocketing or wasting the public's wealth. Anything that kept profits from piling high in a company's coffers could help deter managers from stealing, squandering, or abusing their power. That would have made buybacks beneficial, a view many investors, analysts, and economists still hold today. We can also debunk this myth from a media perspective. If share repurchases were illegal prior to the early 1980s, why did the Harvard Business Review publish a series in 1965 debating share buybacks? Because they weren't illegal. Between 1954 and 1963, more than half of the companies on the New York Stock Exchange bought back shares. For more evidence, let's hear Leo Guthart from the Financial Analyst Journal, Volume 23, Number 2 in 1967. The number of large, well-known companies listed on the New York Stock Exchange that have been buying back their own common stock has been increasing rapidly in the recent past. The next quote is from a 1971 review of the book The Repurchase of Common Stock by Charles Ellis. Repurchasing of common stock is undertaken with such frequency and volume that it is sure to impact corporations, individual investors, and the securities market. To ignore repurchasing is to omit a significant element of corporate financial policy. While share buybacks weren't as popular with the corporate managers in the late 60s and 70s, that doesn't mean they didn't occur. Zweig points out that between 1971 and 1984, Teledyne bought back 90% of its stock. This happened under Chief Executive Henry Singleton, also known as the smartest businessman I ever knew, by Charlie Munger. Bottom line, though the myth that share buybacks were illegal before the 1980s remains popular today, especially among politicians, it's false nonetheless. The next myth. CEOs always think their stock is cheap and waste money buying back shares when it's overvalued. There's a CNBC headline from 2018 that stated, "Investors should be furious. 3 blue-chip stock buybacks that went horribly wrong." The media and politicians love to focus on CEOs who buy back stock only to see their share price decline. Somehow, such a mistimed purchase is supposed to reflect poorly on the concept of what a share buyback itself is. Of course, that's about as logical as characterizing a vehicle as nothing but a tool of destruction, ignoring the inexperienced teenage driver who steered it into the telephone pole. Nevertheless, many people respond with glee when corporate stock buybacks appear to be mistimed. One illustration is the CNBC article from 2018 cited above, and from the article, now with stocks off their highs and many in bear market territory, a decline from an all-time high of 20% or more, it's becoming clear that corporate treasurers are as bad as everyone else when it comes to market timing. In fact, the buyback effect on stocks is waning, as evidenced by 2 popular exchange-traded funds that track buyback indexes. You can always find an example of a stock buyback that, with the benefit of hindsight, appears poorly timed. But here's 5 points on this. First, from the investor's standpoint, this myth is funny, as we usually respond with the simple question, why are you buying overvalued stocks in the first place? Second, most CEOs know when their stock is selling at attractive or unattractive prices for buybacks, and they act accordingly. As just one example, take JP Morgan Chase's CEO Jamie Dimon from May of 2024. I want to make it really clear, okay? We're not going to buy back a lot of stock at these prices. Buying back stock of a financial company greatly in excess of 2 times tangible book is a mistake. We're not going to do it. Now, a skeptic might argue that Dimon is an outlier, and according to surveys, most CEOs believe their stock to be cheap. But that brings us to our third and weightiest point. Is it a case of watch what I say or watch what I do? Do studies conclusively show that corporate managers consistently mistime their share buybacks, paying high prices that destroy value in the process? No. Let's begin with a study, Do Firms Buy Back Their Stock at Bargain Prices? Evidence from actual stock repurchase disclosures from Ben Raphael, Obed, and Wall, as published in the Journal of Financial Economics in 2011. In the paper's abstract, the authors write, using new monthly data, we investigate open market repurchase executions of U.S. firms. We find that firms repurchase at prices which are significantly lower than average market prices. This price discount is negatively related to size and positively related to market-to-book ratio. Firms' repurchase activity is followed by a positive and significant abnormal return. The same conclusion is corroborated by the study, Can Managers Time the Market?, evidence using repurchase price data from the Journal of Financial Economics. Using a data set of all U.S. repurchases from 2004 to 2011, we compare the actual average price paid monthly in a repurchase with the average market price for the same stock over various horizons. We find that firms repurchase stock at a significantly lower price than the average market price in all sample years. Less frequent repurchasers, firms that repurchase when insiders buy on their own account, and firms that experience low stock returns prior to the repurchase obtain significantly lower prices. After controlling for risk factors, repurchasing firms earn positive returns. Infrequent repurchasers earn a significantly higher return up to 3 years following the actual repurchase. Now, an astute listener may argue, the prior two studies merely suggest that repurchases tend to transact at prices lower than average market prices. However, that doesn't mean those prices are actually discounted prices that create value for shareholders. They can be lower than average market prices and yet still be too expensive for buybacks to be a wise use of capital. And that's a fair point. And at the heart of it all is the concept of intrinsic value we've discussed in prior chapters. Of course, intrinsic value isn't a clean, black and white calculation that's easily quantified for every firm. So as a proxy, let's look at buybacks through the lens of cheap to expensive quintiles. To help us with this, we'll turn to our friends at O'Shaughnessy Asset Management, also known as OSAM. In 2015, OSAM published the research piece, High Conviction Buybacks. A low conviction buyback represented times in which management bought back between 0 and 5% of its shares in any given year. High conviction buybacks reflected when management purchased more than 5% of its shares in a single year, sometimes even greater than 10%. The OSAM study finds a common criticism levied against buybacks is that corporate managers mistime their repurchases, buying back stock at expensive prices. But this hasn't been true for the high conviction buyback firms. Since 1987, roughly half of all high conviction buybacks conducted by large U.S. firms were conducted when the firm's stock was in the cheapest quintile of all large stocks. Fewer than 10% of high conviction buyback firms bought back shares when they were in the most expensive quintile of the market. The same numbers for low conviction firms, only 28% bought back shares when their stock was in the cheapest quintile, and roughly 20% bought back shares in the most expensive quintile. Translating this, there simply isn't a valid argument that CEOs are routinely overpaying for their own shares, especially when conducting a high conviction buyback. Now, select few CEOs pay too much? Absolutely. We'll look at an example in the following chapter on buyback case studies. Yet, that in no way makes it fair, let alone accurate, to generalize and claim that most stock repurchases are executed at lofty, value-destroying prices. Moving on, for our fourth point, proponents of this myth are forgetting something important. There's no shot clock or game over in investing. This means what might appear to be a poorly timed stock buyback today could prove to be a brilliantly timed buyback tomorrow. For example, let's return to CNBC's polemic from earlier. Investors should be furious. 3 blue-chip stock buybacks that went horribly wrong. One of the companies that attacked for its buyback timing was IBM. The article reads, IBM spent an eye-popping $83 billion on buybacks after the Great Recession, according to S&P Dow Jones indices. A lot of those purchases were funded with cheap debt. With IBM stock down over 20% this year and having been stagnant for years, the company could have used its cash much earlier during a difficult transition from mainframe technology to open source software, cloud computing, artificial intelligence. CNBC published this article on December 11, 2018, so did IBM's price continue to stagnate, as the author lamented? Well, no. As of the summer of 2024, IBM's stock total return has risen over 100%. Through this lens, the argument of the anti-buyback crowd weakens substantially. Repurchasing shares prior to a bull run that doubled IBM's stock seems to be a rather fortuitous timing. At a minimum, it opens debate as to whether the timing was awful. Now, one could argue that IBM's managers could have transacted at lower purchase prices in the years that followed the Great Recession, but the core issue isn't about nominal price, it's about valuation. So you'd also have to make the point that the transactions occurred at inflated, value-destroying prices. However, if we use IBM's price-to-earnings ratio as a loose guide, that's not what we find. For context, IBM's average PE ratio over the 10 years leading up to 2018 was 13, according to Y Charts. At a minimum, we can conclude that IBM wasn't aggressively and consistently purchasing its own stock at valuations that were sky high. Might IBM have better timed its share repurchases? Potentially. But if that's your position, your primary grumble is that IBM's managers don't have perfect clairvoyance. Who does? Let's move to our fifth and final point. To the extent that corporate managers have, in fact, bought back shares at the alleged wrong time, consider one likely explanation and then consider an alternative. When the economy is performing strongly, businesses usually generate more free cash flow to allocate to various business initiatives and/or dividends, buybacks, debt reduction, etc. At such robust points in the business cycle, the stock market often trades at higher relative prices, reflecting the healthy condition of the economy and the most optimistic sentiment of the consumer and investor. But fast forward to a downturn. When the economy stumbles, businesses usually generate less free cash flow. Meanwhile, the stock market typically pulls back, reflecting the reduced earnings generated during the challenging business conditions, as well as bearish investor sentiment. Through this lens, it makes sense that some corporate managers would buy back shares at higher prices, not because they're incompetent or intentionally manipulative, but because that's when these managers have more cash flow on hand to make such purchases. Likely, more stock-based options will be in the money and implemented as well. But here's the question to the anti-buyback crowd about to pounce on this is no excuse. If that corporate manager chose to stuff the extra free cash flow under the proverbial mattress, waiting to execute a share buyback until the economy and the market had pulled back substantially, would the anti-buyback camp applaud that as a wise decision? Or would they villainize the CEO for allocating cash to buybacks during a down economic cycle in which workers were likely being laid off, bonuses suspended, and/or new hiring frozen? We have our suspicions. In any case, the idea that corporate managers always buy back shares at the wrong time is unfair, highly generalized, and unfounded. Next myth. Companies are spending so much money buying back stock, they're not reinvesting in their business or hiring more people or paying them more. Here's Senator Elizabeth Warren. Stock buybacks create a sugar high for the corporations. It boosts prices in the short run, but the real way to boost the value of a corporation is to invest in the future, and they are not doing that. Are U.S. corporations opting to enrich their shareholders at the expense of growth and/or their workers? You would arrive at this conclusion if you listen to many of our politicians, but here again, this is a myth that might offer some emotional appeal, yet crumbles when honestly investigated. Proponents of this myth are forgetting something. Companies are generating more profits and cash than they have in years past, so R&D is getting its fair share of the pie. As we dig into the data surrounding this, let's begin with Goldman Sachs' 2019 paper, Buyback Realities. It reads, to start, professors at the University of Massachusetts lay out several concerns about buybacks driving the public debate. At their core is the notion that returning cash to shareholders comes at the expense of investment. This, in turn, harms innovation as well as American workers, who they argue should be getting as much larger share of company profits than shareholders. But when looking at the numbers, Goldman Sachs U.S. portfolio strategists David Kostin and Cole Hunter find many of these arguments don't hold up in reality. In particular, they emphasize that even as companies return a large amount of cash to shareholders, there is sizable reinvestment. In fact, growth investment at S&P 500 companies has accounted for a larger share of cash spending than shareholder return every year since at least 1990, with the largest share repurchasers far outpacing market averages in growth of R&D and CapEx spending. Goldman goes on to point out that capital expenditures and R&D have also been stable over time. In the 3 decades prior to the timing of Goldman's study, corporate cash allocated to CapEx and R&D consistently equaled about 8% of sales. Goldman Sachs isn't the only outfit arriving at the conclusion that buybacks aren't crowding out growth initiatives or spending on CapEx. Here's Cliff Asness, co-founder of AQR Capital Management, with Buyback Derangement Syndrome, as written in the Wall Street Journal. The lead accusation against buybacks is that they starve investment. We can look at aggregate investment directly, examining the investing section of the statement of cash flows for all companies in the Russell 3000, normalize by either total assets or total market capitalization, debt plus equity, Net investment is lower than it was in the 1990s, but positive and much higher than during the 2008 financial crisis. Yet the lack of a precipitous decline in investment doesn't stop critics from complaining about investment-less growth. Next up, the Man Group tackled this crowding out myth in 2018. After debunking it for private companies, it turned to public corporations and their allocation to capital expenditures. From its report, Stock Buybacks, Freeing the Invisible Hand, or Legitimizing the Fat Finger, they say, in the realm of public markets, the data also argue against this criticism. We show the typical representation of recurring capital intensity, CapEx to sales. The latest data point as of December 2018 is 6.3%, only marginally below the average of 6.6% from 1990, the longest time horizon of available data. Bottom line, we see no consistent, sustained evidence that money that would be allocated to R&D and CapEx spend is being redirected to share buybacks at the expense of corporate growth. Finally, how does this discussion look through a global lens? Is the U.S. woefully lacking in R&D spending relative to the rest of the world? Quite the opposite. The U.S. remains the world leader for corporate R&D spend at 42% of the global total, versus Europe at 18%, China at 18%, Japan at 9%. The U.S. was at a third of global R&D spend a decade ago. Yet again, there's very little meat to this attack on buybacks. Now, there's a different yet related point to make in this discussion. A return of capital to investors through share buybacks is a more efficient way to help move capital around the economy, from where its return is less productive to where its return is more productive. Is that not an overall benefit which the anti-buyback crowd should consider? For more on this idea, let's return to the Goldman Sachs research piece from earlier. NYU professor Aswath Damodaran agrees that buybacks aren't coming at the expense of investment. Rather, he argues that large, mature companies returning cash to shareholders allows that cash to be put to more productive uses. So, it's not that companies are investing less, it's that different companies with better growth opportunities are investing instead. Is it better for our economy to see, say, a massive consumer goods company make an R&D investment that might have a ROI of 1%? Or would it be better for that massive consumer goods company to buy back its stock, therein putting money in the hands of its investors who might then invest in smaller, more dynamic companies where that investment might have a 100x ROI comparatively? Stephen Davis, professor at the University of Chicago Booth School of Business, suggests trapping resources in larger and older companies not only inhibits the overall size of the pie, but also tends to reinforce the unequal distribution of the pie. The anti-buyback crowd seems to miss the reality that R&D investment, just for the sake of R&D investment, isn't always a productive thing, let alone equally productive across all sectors and all businesses. On this point, Cliff Asness writes, investors generally do not spend the money paid out in buybacks on champagne bubble baths or other forms of consumption. Rather, they reinvest it in other stocks and bonds. Buybacks thus facilitate a movement of capital from companies that don't need it to those that do. That's how markets are supposed to work. But what about workers? Is the money allocated to buybacks coming at the expense of higher employee wages? Noah Smith in Bloomberg writes, if the link between buybacks and investment is weak to non-existent, then the link between buybacks and wages must be weak as well. In fact, that's exactly what we saw in the mid and late 2010s. Buybacks soared to the highest point ever, but wages also grew at their fastest rate in decades. This wasn't a story of rising pay for chief executive officers pulling up the average. In fact, wage growth in the late 2010s was the fastest at the bottom of the distribution. If buybacks stole money out of workers' pockets, we probably wouldn't be seeing that happen. Of course, it's possible that if buybacks had been banned, companies would have raised wages even more. But there are reasons to doubt that's how it would have shaken out. Companies have proven over the years that they're just fine sitting on piles of cash. Forcing more money into the tank doesn't mean more will be put into workers' pockets. Bottom line, corporate stock buybacks as a destroyer of R&D and/or employee wages is yet another easily debunked argument. Next myth. Buybacks manipulate earnings per share higher so that corporate executives can increase their compensation. Here's a quote from Senators Chuck Schumer and Bernie Sanders. At a time of huge income and wealth inequality, Americans should be outraged that these profitable corporations are laying off workers while spending billions of dollars to boost their stock's value to further enrich the wealthy few. Here's another quote from President Joe Biden. Last year, big oil made $200 billion in the midst of a global energy crisis. It's outrageous. They used those record profits to buy back their own stock, rewarding their CEOs and shareholders. This myth holds that stock buybacks are little more than accounting gimmicks to inflate earnings per share with the purpose of making corporate fat cats even fatter. Now, there's the potential for this to be true because the mathematics are accurate. When stock is repurchased by corporate managers, the same amount of profit is allocated over fewer shares. This increases the earnings per share of those fewer remaining outstanding shares. So all else equal, buying back stock will usually inflate an earnings per share figure. But the first issue is all else equal is often just a theoretical exercise. Cliff Asness explains, another criticism is buybacks artificially raise earnings per share. This is certain only if the rest of a repurchasing company's business is unchanged and the cash used for the buyback was completely idle. Otherwise, the true long-term effect on EPS growth will be determined by the return to the company had it retained and employed the cash. Again, this is how it's supposed to work. If the returns to a company using the cash for a buyback are low, the company is supposed to give the cash back. But theory aside, what's at the heart of this issue isn't the mathematics of how buybacks increase earnings per share, but rather the motivation of corporate managers and the frequency of this type of for optics only buyback. If you listen to many politicians, they'd have you believe that corporate managers are nearly exclusively driven by greed, and the purpose of buybacks is almost always to artificially goose earnings for selfish reasons, usually hitting an earnings per share target that unlocks a bonus. So here again, does the research suggest this is true? No. Beginning with Jason Zweig in the Wall Street Journal, he writes, research does suggest that companies may sometimes use share buybacks to manipulate earnings or to give insiders a chance to cash out at higher prices, but the claim that corporations are repurchasing shares to goose short-term stock prices instead of investing in projects to boost long-term growth is just rubbish. Corporate spending on R&D is at all-time highs, and S&P 500 companies lavished a record $713 billion on capital expenditures in 2018. Alex Edmonds, a professor of finance at London Business School, the UK government commissioned Edmonds and PricewaterhouseCoopers to study the alleged misuse of share buybacks in the UK. Based on his findings, Edmond notes, over 2007 to 2017, we found that not a single FTSE 350 firm used buybacks to hit an EPS target that it would have otherwise missed. And don't make the mistake of thinking it's different in Europe than in the US. Goldman Sachs reached a similar takeaway. Executives whose compensation depends on EPS did not allocate a greater proportion of total cash spending to buybacks in 2018 than companies where management pay was not linked to EPS. The 247 companies in the S&P 500 with incentive compensation programs linked to earnings per share, a metric that would benefit from accretive share buybacks, actually spent a smaller share, or 28%, of their total cash outlays on repurchasing stock compared with the 253 firms without a performance metric linked to EPS at 31%. Moreover, the 49% of S&P 500 firms with EPS-linked compensation accounted for just 45% of total 2018 buybacks at $362 billion. We also found no relationship between how management teams with compensation incentives tied to total shareholder return spent cash relative to those firms with no shareholder return incentive. But there are other holes in this argument's logic, the first of which is that it's only corporate managers who benefit from buybacks. According to the Federal Reserve's 2022 survey of consumer finances, 58% of U.S. households own stocks, whether directly or indirectly. The Wall Street Journal writes that is up from 53% in 2019 and marks the highest household stock ownership rate recorded in the triennial survey. Stock buybacks, to the extent they goose earnings per share, helping support a stock price, don't solely benefit a small cabal of greedy C-suite executives. According to the Federal Reserve's data, they help enrich more than 1 out of 2 American households. Of course, this assumes that the benefits of buybacks aren't short-lived, fading away soon after upper management receives their fat bonuses. Unfortunately for the anti-buyback crowd, the research points towards long-term outperformance of companies that buy back their shares. Edmonds writes, "What about the long-term effects of buybacks? A seminal paper found that firms who buy back stocks subsequently outperform their peers by 12.1% over the next 4 years. This finding is surprisingly robust. While it was on U.S. firms in the 1980s, a recent study investigates 31 other countries and finds that the results hold in most of them. This evidence contradicts the sugar high concerns, but it is conveniently ignored in claims that buybacks destroy long-term value." We can corroborate Edmonds' findings with the study, Share Repurchases on Trial, Large Sample Evidence on Share Price Performance, Executive Compensation, and Corporate Investment. The researchers hypothesized that if unaware retail investors were being duped into buying repurchased shares, their study would reveal short-term price bumps followed by longer-term stretches of poor stock price performance. But that's not the data's conclusion. We find no evidence to support this hypothesis. That is, regardless of whether or how intensely and frequently firms repurchase shares, we find no evidence that firms significantly outperform in the quarters with repurchases. While we find some marginal evidence that firms that intensely repurchase do outperform slightly in the quarter after repurchases, we find no evidence of future reversals in the short or long term. This pattern of outperformance is more consistent with firms using repurchases to signal undervaluation rather than to manipulate the market. Now, a skeptic might argue that any benefit to ordinary investors and/or households, even if on a longer-term time frame, is purely an unintended collateral benefit from selfish CEOs acting in their own financial best interest. And even if a rising stock price benefits all shareholders, corporate managers are the ones who enjoy the lion's share of the payoff, cashing in with multi-million-dollar bonuses. However, this belief is quickly debunked. Researchers at the University of Wisconsin and the University of Kentucky evaluated dual share class firms with active trading in both share classes. They sought to isolate the magnitude and duration of the demand-drive price impact of stock buybacks. From their study, The Price Effect of Stock Repurchases, Evidence from Dual Class Firms, they write, "The average repurchase in our sample, 0.3% of outstanding shares within a month, increases the stock price by 40 to 70 basis points relative to the non-repurchase class of stock. The effect dissipates completely over the subsequent month unless extended by continued repurchases. This small, short-lived price effect leaves little scope for CEOs to benefit from value-destroying repurchases motivated by self-interest. A back-of-the-envelope calculation suggests that the average CEO could create an additional $12,500 a year in direct benefits from repurchases, a trivial fraction of a CEO's $5.6 million average annual compensation." Meanwhile, the study we referenced moments ago arrives at a similar takeaway. The authors speculated that if using repurchases to reward insiders were a common, systematic abuse, CEOs who use repurchases would receive abnormally high pay. However, that's not what the study found. We estimate that CEOs of firms that make large positive repurchases earn a statistically and economically insignificant amount of excess pay that is only $51,000 more than CEOs of firms that do not repurchase shares. The difference is even smaller, $4,000, when we compare CEOs of firms that repurchase frequently to firms that do not repurchase. These differences are economically tiny in relation to the average CEO's pay. There's also plentiful anecdotal evidence against this myth. One such illustration comes from the research paper, Which One Is It?, from Michael Mauboussin. He tells the story of meeting with a CEO in 1999 who was struggling with a capital allocation decision. This CEO had issued significant stock-based compensation grants to employees, yet had promised the financial community that he would offset the dilution by buying back stock in order to maintain roughly equal share count. The problem is that the stock price of this CEO's company had soared thanks to the dot-com bubble and was now overvalued. The CEO recognized this and felt torn. Mauboussin writes, "He had painted himself into a corner, and the question was whether he should continue to buy back stock at a premium to maintain his pledge or limit buybacks and allow the number of shares outstanding to rise. If this CEO was thinking purely about his own self-interest, the decision wouldn't have been difficult or stressful. Instead, he would have wasted zero time buying back the stock, valuation be damned, to hit his numbers, goose the earnings per share, and cash in that fat bonus check. But that type of blatant disregard for important capital allocation decisions isn't what we find. Here again, the myth doesn't hold up to serious, honest evaluation. Stepping back, we're sympathetic to the argument that CEOs are paid too much, but that question and the discussion is a board issue and largely has nothing to do with a stock buyback decision. If a board gives a CEO a giant pay package with options tied to earnings per share, then that's a poor decision and it's on them. But realize that such a compensation package achieves the exact opposite result, share issuance. Historically, owning companies with consistent share issuance has been a bad idea. Bottom line, the myth that stock buybacks are regularly executed to artificially inflate earnings per share so that corporate executives can receive higher compensation makes for a powerful political talking point, but it's baseless. The research and studies simply do not validate it. The next myth: buybacks weaken already distressed companies. Here's a quote from William Lazonick. When companies do these buybacks, they deprive themselves of the liquidity that might help them cope when sales and profits decline in an economic downturn. This myth holds that share buybacks exaggerate the economic challenges facing distressed companies. One illustration of this argument can be found in the quote above. It comes from the article, Why Stock Buybacks Are Dangerous for the Economy by Lazonick. And to what extent is this true? Are ailing corporations turning a blind eye to prudent uses of capital and instead weakening themselves further by conducting stock buybacks? Now, as we've seen with prior myths, this is possible. We could find select examples of CEOs allocating cash to buybacks when it should be directed elsewhere. We'll look at one such example in the next chapter. However, for this charge to be considered seriously and hold any weight, it must be happening on a wide-scale, consistent basis. But this idea raises an eyebrow from the get-go. Framed differently, it suggests that corporate buybacks are impossible to resist even for incredibly well-educated, high-performing men and women who have beaten all the competition and made it to the top of the corporate hierarchy. Yet for all their intellect and discipline in becoming captains of industry, these C-level business leaders are no match for the siren song of a good old buyback. This makes buybacks an existential problem for the ailing businesses of weak-kneed managers who should know better. Here again, the data don't support this conclusion. Instead, we find that buybacks are most often conducted by healthy companies. This makes sense. Buybacks are an outgrowth of a well-run business that's spinning off free cash flow, making such buybacks possible. But let's look at the research so you can see for yourself. Here's 2 Sigma from their article, Share Buybacks, A Brief Investigation. Stocks announcing a share buyback tend to have significantly stronger fundamentals than average, with higher scores on earnings yield, so lower price-to-earnings ratio, earnings quality, i.e. more cash earnings, and profitability. Example, higher return on equity and return on assets. These firms also tend to be larger, with lower leverage and lower market-implied risk. These results suggest that corporations buying back stock are exactly those with the greatest ability to return cash to shareholders while still supporting future growth. The research provides little evidence that the firms are consistently endangering themselves through excess leverage to fund the capital returns. Speaking of excess leverage to fund corporate stock buybacks, that's mostly just a boogeyman. After highlighting criticism for firms are borrowing unsuitably to buy back stock, the Mann Institute writes, "We have little to say in the argument other than, in aggregate, it appears factually wrong according to our analysis." Bottom line, whether we look at the fundamental strength of companies performing share buybacks or evaluate the stock prices of such companies, we don't find a consistent, widespread pattern of abuse wherein the corporate managers of ailing companies are hollowing out their businesses through share buybacks. As we wrap up this chapter, it seems curious to us why buybacks would be so villainized. They are neither good nor bad. They simply are. Perhaps some CEOs might occasionally use them inappropriately, but if so, wouldn't that reflect poorly on the CEO and not the buyback itself. We believe Michael Mauboussin hits the nail on the head in his article, Share Repurchases from All Angles, when he states, the purpose of a company is to maximize long-term value. As such, the prime responsibility of a management team is to invest financial, physical, and human capital at a rate in excess of the opportunity cost of capital. Operationally, this means identifying and executing strategies that deliver excess returns. Outstanding executives assess the attractiveness of various alternatives and deploy capital to where its value is highest. This not only captures investments including capital expenditures, working capital, and acquisitions, but also share buybacks. There are cases where buying back shares provides more value to continuing shareholders than investing in the business does. Astute capital allocators understand this. However, while astute capital allocators understand, many politicians do not. As one example, we have President Joe Biden Inflation Reduction Act of 2022 that imposed a 1% excise tax on the value of corporate net share repurchases. Charlie Munger was not shy about expressing his displeasure for the idea, saying, I think it's insane. Literally insane. It's so irrational, and I think it sort of destroys the whole system once you start tinkering from Washington. As we referenced in Chapter 3, Buffett also has an interesting take on this blanket villainization of buybacks. Rather than our prior annotated version, here's his full quote. When you are told that all repurchases are harmful to shareholders or to the country, or particularly beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue. Characters that are not mutually exclusive. So how do we end this section on buyback myths? By going straight to the Oxford Dictionary definition of a myth, a widely held but false belief or idea. That's exactly what we have here. Chapter 6, Stock Buyback Case Studies. The anti-buyback crowd seems to miss or downplay a core truth. Being a CEO is hard. Every day, CEOs face tough decisions as they do their best to navigate fierce competition and economic conditions that are nearly always in a state of flux. To succeed in this cutthroat, ever-shifting climate, CEOs only have 5 choices for how to deploy their company's cash. 1. Reinvest in the business directly. 2. Buy another company. 3. Pay down debt. 4. Pay a cash dividend. And 5. Buy back stock. That's it. There are 0 other options. In Figure 10, we have a nice flowchart courtesy of Josh Wolf at Lux Capital on how a CEO may optimize their cash flow to various projects and distributions. This, along with other figures, can be found on shareholderyield.com. What we want to answer in this chapter is, when is buying back stock the right use of a company's cash, and what does that actually look like? To do this, we'll use historical case studies as our guide. But after walking through 3 such examples, we'll round out our discussion by looking at a case of buybacks gone wrong. After all, we're not here to make the argument that all buybacks are good no matter what. That would be too simplistic and reductionist, the foil to the anti-buyback crowd's attack of all buybacks are bad no matter what. Instead, we believe buybacks can do good, exceptionally good at times, yet also poorly considered, even injurious at other times. Of course, as noted in the last chapter, it's our belief that this potential for variable success should be the spotlight on the CEO wielding the buyback, not the institution itself. So, with this as our introduction, what are some examples of buybacks done right? Before we're able to investigate, we must clarify what defines a successful buyback. The knee-jerk answer might be something like, the stock price climbs materially higher in the subsequent weeks, quarters, or years following the buyback campaign. However, while we do all agree this is a criterion, it's not complete. After all, a rising stock price in the wake of buybacks could be little more than lucky timing. A clumsy corporate manager might repurchase shares at a wildly overpriced valuation, yet benefit from a rising tide lifts all ships market environment that camouflages the poor timing. So, materially higher stock prices alone can't be the answer. We believe a second key component to success is a predetermined, well-thought-out methodology that's carried out according to plan. So what does this look like in the real world? First case study, Berkshire Hathaway. Quote from Warren Buffett, CEO of Berkshire Hathaway. When stock can be bought below a business's value, it is probably the best use of cash. Warren Buffett is a huge proponent of stock buybacks. He's also had much to say on the topic over his multi-decade investment career. One such comment came in 2016 at Berkshire Hathaway's shareholder meeting when the Oracle of Omaha said, "Anytime you can buy stock for less than it's worth, it's advantageous to the continuing shareholders, but it should be by a demonstrable margin." While this idea is simple, the application is often more challenging. That's because the definition of a stock's worth is seldom obvious. As we pointed out in Chapter 4, there's no single metric or indicator providing a black and white number that accurately identifies intrinsic value. Even Buffett himself has said, calculations of intrinsic value are far from precise. However, a moment ago, we suggested that a buyback done right occurs when a CEO has a predetermined, well-thought-out methodology that's carried out according to plan. So what does this look like for Buffett, factoring in his resolve to purchase shares at a price below intrinsic value, while recognizing that identifying intrinsic value can be challenging? As we pointed out in Chapter 4, Buffett's buyback methodology was simple, 1.1 to 1.2 times book value. In other words, when Berkshire Hathaway's stock traded at or below 1.2 times its book value, Buffett considered it an attractive price relative to Berkshire Hathaway's intrinsic value. So, he would repurchase shares with the confidence that he was creating value for shareholders. Now, this 1.1 to 1.2 times book value guideline hasn't been perfectly followed. Buffett has repurchased Berkshire Hathaway shares at slightly higher levels in recent years, but the concept remains his guiding principle. Generally, when price to book is elevated, Buffett repurchases 0 shares or the volume is small. Conversely, when price to book nears 1.2 or below, Buffett ramps up the buyback sharply. Now, we can check the box on our second metric for buyback success. Buffett obviously has a predetermined, well-thought-out methodology that's carried out according to plan. What about the first criterion, a stock price that climbs materially higher in the subsequent weeks, quarters, or years following the buyback campaign? Any long-term chart of Berkshire Hathaway's stock shows that Buffett has accomplished this and more. For example, over the last 20 years, Berkshire has returned more than 600% compared to the S&P's 400% gain. In Buffett's tenure running Berkshire Hathaway, he's compounded shareholder wealth at 19.8% annual returns, nearly doubling the S&P's 10.2% return over the same period. The most unbelievable statistic in all of investing? Berkshire's stock price could decline by over 99% and still be outperforming the S&P since inception. We're serious. Go look it up. Bottom line, given Buffett's fondness for and extensive use of share buybacks over the decades, it's hard to do anything other than agree with him. As he once said, disciplined repurchases are the surest way to use funds intelligently. It's hard to go wrong when you're buying dollar bills for 80 cents or less. Next case study, Teledyne. It's an easy leap going from Warren Buffett to Henry Singleton, the visionary CEO of Teledyne. After all, Buffett once said, Henry Singleton has the best operating and capital deployment record in American business. And Buffett's partner, Charlie Munger, was quoted saying, Singleton's results are a mile higher than anyone else. Utterly ridiculous. What made Singleton's results so ridiculous? In short, he was a master at capital allocation. But a tremendous part of his genius came through his superb use of stock buybacks. Stepping back, if you're less familiar with Singleton, he was the CEO of Teledyne Corporation from 1966 through his retirement in 1986. During the first part of Singleton's career, he used Teledyne's capital for acquisitions. By the end of the 1960s, Teledyne had acquired 130 companies, growing rapidly under Singleton's leadership. But then came the bear market of the early 1970s, and two things happened. The first is the growth from acquisition was no longer the best use of corporate cash. Singleton is quoted as saying, in this climate, where tender offer means overpaying by managements which want to grow at any price, I prefer to buy pieces of other companies or our own stock or expand from within. The price for buying an entire company is too much. Tendering at the premiums required today would hurt, not help, our return on equity, so we won't do it. The second thing that happened is Teledyne's own stock crashed. As George Roberts and Robert McVicker describe in their book, Distant Force, a memoir of the Teledyne Corporation and the man who created it, Teledyne stock fell from roughly $40 to less than $8. And here's where we see Singleton's predetermined, well-thought-out methodology carried out according to plan. To be clear, Singleton wasn't as specific as Buffett in his 1.1 to 1.2 times book guideline, but he was equally focused on the idea of value, once saying, "I don't believe all this nonsense about market timing. Just buy very good value, and when the market is ready, that value will be recognized." Singleton possessed an instinct for value, so when Teledyne stock crashed, he recognized the potential value add for investors and acted immediately. From Roberts and McVicker in Distant Force. One morning in May of 1972, Henry walked into my office at about 8:30 and said, "George, we're going to make a bid for our stock at $20 a share." I said, "Are we really going to do that?" I was totally amazed, and he hadn't even hinted to me about that before. This was an example of how Henry made all investment and stock decisions on his own. They were all done when our stock was at a low PE ratio. He believed that our stock was grossly undervalued, and it was the first of a series of 8 stock buyback offers. The first 6 buybacks were all in the period from 1972 to 1976. The market reacted adversely to this at first, not understanding what Henry was accomplishing. But as the number of shares went down and the company's operating income continued to grow, the earnings per share increased rapidly and dramatically. In 1970, net income per share was $1.64. By 1975, it was $6.09 per share. In 1976, $10.79 per share. And in 1977, $16.23 per share. So, what's the legacy of Singleton's legendary buybacks? Well, there's much more than we could write, but let's focus on 2 aspects. First, for the anti-buyback crowd that would prefer investing in, say, R&D and/or new acquisitions, recognize what Singleton was signaling to the market through his buybacks. At its core, the message was, our own company has amazing growth prospects as it is, so buying ourselves at this bargain basement price is the absolute best use of our cash. Is this not the confidence and vision that we would hope for from all of our corporate leaders? Well, yeah. If Singleton was correct in his assessment of Teledyne's future and its bargain stock price at the time of the buybacks, so was he? As to a rising stock price, in Distant Force, Roberts and McVicker write, shareholders who had stayed with the company from the first buyback in 1972 had achieved a gain of some 3,000% by 1983. For a bit more color, here's Christian Hald Mortensen from his paper, Teledyne Technologies, a conglomerate phoenix that rose from the ashes with Henry Singleton's corporate DNA intact. An investor who came across the founder Henry Singleton and put money into Teledyne stock in 1966 achieved an annual return of 17.9% over the next 25 years, or a 53x return on invested capital. Clearly, our criteria of a stock price that climbs materially higher in the subsequent weeks, quarters, or years following the buyback campaign is met. Meanwhile, though our other criteria of a predetermined, well-thought-out methodology that's carried out according to plan, yes, Singleton checks the box, repurchasing shares when he believed he was doing so at value-add prices. But let's not miss Singleton's overall genius in recognizing the shift in the corporate landscape, away from acquisitions when price tags grew too expensive, towards buybacks. It's all but certain that Teledyne's 53x return wouldn't have been possible without this expert use of share buybacks. Summing up Singleton and Teledyne, consider this quote from the great Peter Lynch. Buying back shares is the simplest and best way a company can reward its investors. If a company has faith in its own future, then why shouldn't it invest in itself, just as the shareholders do? That's exactly what Singleton did, and that's why he's one of the greater capital allocators of all time. Next case study, Apple. So far, we focused on buybacks that have been executed at low valuation multiples, but could buybacks ever be a value add for investors when executed at higher valuations? Investors often assume that intrinsic value is best expressed through a low valuation multiple like the PE ratio. Is a company trading at a PE ratio of 10 cheap compared to another company trading at a PE ratio of 20? On average, the answer is probably yes, but simple valuation ratios often leave out a major input to an intrinsic valuation calculation: growth. What if the cheap stock, in the example, isn't growing earnings, but the expensive stock is growing at 50% per year? Growth and value are tied at the hip when it comes to valuing a company. Buffett illustrates this concept and has put his money where his mouth is by making Apple the single largest holding in Berkshire Hathaway's portfolio. This is accurate as of summer 2024, even after news is broken that Buffett has reduced his stake in Apple by nearly 50%. When Buffett first started buying Apple in 2016, it traded at a P ratio of about 10, fairly cheap by historical standards. Since that time, the stock has been a multi-bagger and is now one of the largest companies and stocks in the world. The share price growth has led Apple to a more richly valued P/E ratio of approximately 35 in the summer of 2024. Apple started buying back its stock in scale beginning in 2013. And while these buybacks have become legendary for their enormity, they're not renowned for their adherence to a low PE multiple criterion. And yet, this doesn't seem to be a problem for the Oracle of Omaha. Let's rewind to this CNBC article from September of 2018 when Apple was trading around its then all-time high. When asked whether investors should be worried about the stock market at a record level, Buffett said that buybacks make owning the iPhone maker a no-lose situation right now. I'd rather have it go down for one thing. If it goes down, Apple is going to be buying a lot of stock back, already buying stock back, he said. If it goes down 10%, it means they'll get to buy 10% more shares and my interest will go up 10% more for spending that money. The article contained no mention of Buffett referencing, let alone complaining about, Apple's buybacks transacting at a higher PE multiple. But let's not speculate about Buffett's thoughts on this matter. Instead, let's rewind to how he approached this exact issue with one of his favorite holdings, Coca-Cola, and its potential buybacks during a period of inflated PE levels. Years ago, a young Bill Ackman asked Buffett about Coke repurchasing its shares at a PE of 40. Here's part of Buffett's response. It sounds like a very high price when you name it, in terms of a PE, to buy back the stock at that sort of number. But I would say this. Coca-Cola has been around, 112 years now? And there are very few times in that 112 years, if any, when it would not have been smart for Coca-Cola to be repurchasing its shares. We love it when Coke repurchases shares. All I can tell you is I approve of Coke repurchasing shares. I'd a lot rather have them repurchasing shares at 15 times earnings, but when I look at other ways to use capital, I still think it's a very good use of capital. And maybe the day will come when they can buy it at 20 times earnings, and if they can, I hope they go out and borrow a lot of money to buy a ton of it at those prices. Buffett's easing of his strict standards about buybacks relative to intrinsic value seems to relate to the quality of the underlying business. In this same response to Ackman, Buffett praises Coca-Cola's operational excellence while noting that most companies are not as well run. This makes an enormous difference when it comes to the efficacy of share repurchases. What he's done with Coca-Cola, Buffett has similarly praised Apple's business excellence. So through this lens, it makes sense why he wouldn't have a problem with Apple buying its shares at somewhat elevated prices. It appears he'd rather own a great business that's buying back loads of stock than a mediocre business selectively repurchasing shares at low prices. After Buffett answered Ackman, Munger chimed in, saying, "The really great companies that buy at high price earnings, that can be wise." This has shades of another of Buffett's famous quotes. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Returning to Apple specifically, when we look at its buyback strategy, we find something different than that of Berkshire Hathaway, a blunt force sledgehammer approach rather than a precision scalpel approach. But sledgehammers can be very effective. In the spring of 2024, Apple announced the largest share buyback in U.S. history, $110 billion. This broke the prior buyback record of $100 billion from Apple in 2018. And let's not forget Apple's other recent share buybacks. In 2019, $75 billion, 2020, $50 billion, 2022, $90 billion, 2023, $90 billion. Over the last few years, Apple has generated roughly $100 billion in annual free cash flow each year. When a company generates this much cash, it's hard to reinvest it all in the business. Now, let's tackle the most obvious objection up front. That's no excuse. Apple should have invested its cash stockpile into R&D initiatives and business ventures. They did, and they lost every dime. There's the ill-fated Project Titan, which was Apple's foray into the world of electric vehicles beginning back in 2014. The Apple Car was supposed to take on Tesla head-to-head. Instead, in early 2024, Apple gave up on the project. That meant after a decade of effort and an alleged $10 billion of R&D expense went down the drain. With the gift of hindsight, it's clear that this $10 billion would have been put to far better productive use had Apple returned it to shareholders, wherein they could have reinvested into more productive ventures. This ties in with the point we highlighted in Chapter 5 from Goldman Sachs' research paper. Aswath Damodaran agrees that buybacks aren't coming at the expense of investment. Rather, he argues that large, mature companies returning cash to shareholders allows that cash to be put to more productive uses. So it's not the companies that are investing less, it's that different companies with better growth opportunities are investing instead. When you're among the biggest companies in the world, it's hard to find projects that have the potential to move the needle from a return on investment perspective. So why not follow Damodaran's advice and let shareholders find more productive uses for it? Yes, that might mean transacting at higher PE multiple prices, but to what extent is that really resulting in a destruction of value if the company is growing? In 2012, Buffett revealed that the late Steve Jobs had once asked his advice on Apple's cash management strategy. Buffett responded, "I asked him the question. I said, I would use it for buybacks if I thought my stock was undervalued. And I said, how do you feel about that? He said, I think my stock is very undervalued. I said, well, what better to do with your money? Jobs declined to initiate a buyback program, and it wasn't until May 2012 that Apple announced plans to initiate a dividend and share repurchase program for the first time in the 2000s. Since that date, Apple shares have climbed more than 1,320% and are trading at all-time highs as of the summer of 2024. In Figure 11, we show how this looks with Apple's share count decreasing in purple against its stock price climbing in orange. You can find this and all other figures in the downloadable PDF at shareholderyield.com. Imagine the value creation had Jobs taken Buffett's advice. Circling back to our analysis of the efficacy of Apple's buybacks and the criteria for success we're using, our criterion of a stock price that climbs materially higher in the subsequent weeks, quarters, or years following the buyback campaign is achieved, and then some. But what of our second criterion of buyback success? A predetermined, well-thought-out methodology that's carried out according to plan. Well, it seems in recent years that Apple does, in fact, have a predetermined, well-thought-out methodology that's carried out according to plan, and that's buy enormous quantities of its own stock regularly, even if the price doesn't represent a bargain basement PE multiple. It seems like it's working. When buybacks are suboptimal. As noted earlier, we're not blindly championing all stock buybacks. They can be abused, same as every other use of corporate cash. Let's look at one such example with General Electric, one of America's best-known multinational conglomerates with a history dating back to its 1892 founding by none other than Thomas Edison and J.P. Morgan. For decades, GE was venerated for its innovation and diverse portfolio of business initiatives. In more recent years, this lineup has included power generation, aircraft engines, healthcare, renewable energy solutions, and far more. GE's former CEO, Jack Welch, is widely regarded as one of the most influential CEOs in the history of corporate America. And for a period in 2000 under Welch, GE was the world's most valuable company. As recently as 2011, it still held the title of fifth largest company in the world. But when the 2008 and 2009 great financial crisis dealt a massive blow to GE Capital, cracks began showing. As The Week wrote, as entangled as it was in the mortgage bubble and the shadow banking sectors, GE Capital toppled over. At the height of the 2008 crisis, literally no one would lend to it in the overnight markets. GE Capital was only saved by an emergency injection of $12 billion from Warren Buffett and other investors. For the first time in its history, GE had to slash its dividend payments from 30 cents to 10 cents a share, a massive two-thirds reduction. In terms of total dollars going to shareholders, it was the biggest single dividend cut by an American company ever. Additional dominoes tipped over. There was the ill-fated purchase of Alstom, an SEC charge of overall aggressive accounting and false statements, and finally, poorly timed stock buybacks. Here's CNN Business from March 2018. General Electric is seriously strapped for cash. The conglomerate has laid off workers, slashed its dividend, and put long-held businesses up for sale. If only former CEO Jeff Immelt hadn't gone on a $24 billion spending spree in 2016 and 2017 to buy back GE stock at what turned out to be extremely high prices. The misguided buyback strategy underlies GE's failure to allocate its limited resources. It squeezed GE's cash haul and increased its debt. The root problem at GE, and why the stock is where it is poor capital allocation, said RBC Capital Markets analyst Dean Drey. We look at this poor capital allocation in a chart spanning 2010 to 2020. We're looking at GE's quarterly stock buybacks in blue and its stock price in orange. You'll see how GE trafficked in what the anti-buyback crowd loathes, an increase in buyback volume that parallels an increase in stock price. But as you're likely aware, price does not equal value. Might GE shares have been selling for a higher price in 2017, yet due to increased earnings, that price represented a more attractive valuation? The PE ratio spiked from roughly 10 in early 2015 to 25 when General Electric was conducting the lion's share of its quarterly share buybacks in 2016. Back to CNN Business from 2018. Using a combination of debt and cash, GE spent $2.6 billion in 2017 on stock buybacks at an average price of $19.65. At the time of the article's publication in 2018, the stock was worth just $13.35, close to a 9-year low. GE's buybacks were much worse in 2016. It spent $21.4 billion at an average price of $30.30, more than double the current price. Our main determinant of a successful buyback has been a predetermined, well-thought-out methodology that's carried out according to plan and that incorporates buying stock at a discount to intrinsic value. Though its stock is now finally trading around its 2016 high level as of summer 2024, the rehabilitation has taken the better part of a decade. As for a predetermined plan, it's possible that then CEO Jeff Immelt felt he had one, though if so, it's unclear what it was. Unlike Buffett and Singleton, Immelt didn't ramp up stock repurchases when GE shares were trading at a bargain price. And unlike Apple, GE didn't execute consistent buybacks year in, year out. Overall, at the risk of being unfairly reductionist, it appears Immelt used GE's cash for stock repurchases at the wrong time. Given the financial and strategic stresses the company was under, plus its relatively rich valuation at the height of its buyback campaign, GE gives us an example of a flawed stock repurchase campaign. As Mark Cohodes once said, when your business is not doing well from a fundamental perspective, the last thing you're supposed to do is buy back stock. We agree. And though GE provides us a powerful cautionary tale about ignoring this guideline, it is the exception rather than the rule. Chapter 7. Shareholder Yield. Let's get our bearings. In our introduction, we noted that the goal of this book is to investigate capital allocation decisions and how they impact stock prices and investor returns. As noted in our last chapter, there are only 5 ways that managers can allocate their capital. 1. Reinvest in the business directly. 2. Buy another company. 3. Pay down debt. 4. Pay a cash dividend. 5. Buy back stock. In a perfect world, we'd be able to draw a direct connection between the amount of capital allocated to each of these 5 uses of corporate cash and their respective returns. Such a direct yield analysis would make this book's investigation far easier. Unfortunately, it's not that simple. To illustrate why, consider reinvesting directly in the business and/or buying another company. The returns of these efforts can be difficult, if not impossible, to evaluate and quantify precisely. After all, sometimes a business initiative pays off immediately. Other times, it requires years or decades. Meanwhile, some acquisitions might provide a robust return of capital at first, only to be followed by a meager return streams in later years. A different acquisition might have had the opposite result. Then, how can a manager be certain that there's no collateral benefit from some other ancillary business initiative boosting returns or weighing on returns? The challenges don't stop there. Imagine a business investment or acquisition that's fantastic for brand development or polishing a corporate image, yet how do you quantify that benefit specifically? For reasons such as these, evaluating reinvesting in businesses directly and/or acquisitions from a yield perspective is rather quixotic. Fortunately, we can achieve far greater success when evaluating dividends, stock buybacks, and debt reduction through this yield lens, which, as we'll discuss momentarily, leads us into a discussion of our titular shareholder yield. Now, we've broadly discussed dividends and share buybacks at this point, but what about debt? If we could go back in time, we would not include the debt paydown component in our discussion as it usually confuses people. However, since the original book incorporated the debt metric, we wish to stay consistent and retain the original definition. But we'll offer brief commentary before we move on in an effort to avoid any lingering questions. The seminal paper, The Cost of Capital, Corporation Finance, and the Theory of Investment by Modigliani and Miller demonstrated that a firm's value was separate from how it's financed. If a company decides to deleverage and pay down debt, it can be seen as a transfer of wealth from the debt holder to the equity holder. Another way to think about it is that if a company carries significant debt, then the bondholder is higher on the capital stack than the stockholder. Compared with dividend payments and/or stock buybacks, debt reduction is a subtler form of rewarding shareholders. After all, the debt paydown doesn't directly flow to a shareholder, yet by reducing the amount of debt owed to the bondholders who have a superior position in the capital hierarchy, debt reduction is inherently value additive for equity investors. But as you might guess, drawing a direct line between debt reduction and a specific quantifiable return to shareholders and/or a stock price is challenging. This is part of the reason why, as noted a moment ago, we're including debt paydown in our discussion to remain consistent. So, with all this as our background, does including this additional data on dividends, buybacks, and debt reduction together, the basis for our shareholder yield calculation, improve the ability to forecast investment returns in stocks? Ample research answers this question in the affirmative, and we include a literature review at shareholderyield.com. We further provide our own research now, which validates the conclusions of the research completed to date. In the first edition of this book, we examined U.S. stocks from 1982 to 2011. In this new edition, we expand the dataset to include the out-of-sample decade since publication and a decade before the original start date. So the new period covers 52 years, from 1971 to 2022, with over 20 years of new data. Since various researchers have different conceptions of yield measurement, an investor must be careful to maintain a consistent definition. We define a few different cash flow metrics and methods of cash distribution to discuss the research on an apples-to-apples basis. Dividend yield is trailing 12 months cash dividends divided by market capitalization. Basically, this means the total value of cash dividends the company paid out divided by the stock's market value. Net buyback yield is trailing 12-month stock repurchases minus stock issuances divided by market capitalization. Basically, this means the total value of stock buybacks divided by the stock's market value. The easiest way to track this is with shares outstanding. Net payout yield is dividend yield plus net buyback yield. Basically, this is the combination of the two prior. Then there's net debt paydown yield. So net changes in short and long-term borrowing and debt divided by market capitalization. Basically, this means the total value debt a company has paid down divided by the stock's market value. And lastly, shareholder yield. So dividend yield plus net buyback yield plus net debt paydown yield. In evaluating stock repurchases and debt reduction measures, it is important to use net buyback and paydown statistics to account for companies issuing lots of shares or debt while buying back stock and paying down other debt. Otherwise, one risks overvaluing those companies that buy back stock with one hand, but issue it to management with the other hand through executive stock option packages. Next is a visual representation of stocks in the S&P 500 as of April 2024 and how their yields compare when combining dividends and buybacks. The median stock in the dividend portfolio has a respectable 3.7% net payout yield, over 2 percentage points better than the S&P 500's 1.15% total net payout yield. However, the top net payout yield portfolio yields 5.7%. Combining the two measures produces a net payout yield that is multiples more than the S&P 500 portfolio. About 60% of all stocks in the S&P 500 have a positive net payout yield. Investors should avoid the bottom stocks as they dilute shareholders. The bottom 10 offenders were excluded in this next chart, so it would still even be readable. Interestingly, over half of all the companies with a negative payout yield have a positive dividend, including 20 companies with a dividend yield over 3%. This demonstrates why it's so important to examine how companies use their cash, as investors may believe they have a good dividend-paying stock, when in reality, the stock likely has a negative yield and is diluting your ownership by issuing new shares, often to management. Next up, we have a summary risk and return statistics table for the S&P 500 and portfolios divided into quartiles based on dividend yield and shareholder yield, market capitalization weighted, and rebalanced yearly. Quartiles divide the universe into 4 buckets, where 25% of the universe, or 125 companies, fall into each bucket. Market capitalization weighting can result in more conservative returns to a portfolio than equal weighting, and more conservative trading assumptions for very large portfolios. A simple method of investing in the highest yielding dividend stocks outperforms the S&P 500 by over a percentage point a year, consistent with most academic research. So you have 10.35% for U.S. stocks and 11.51% for dividend stocks. Volatility aligns with the broad market, although drawdowns are higher, likely reflecting the increased risk to companies with higher, possibly unsustainable dividend payments. And we measure drawdown by the maximum monthly peak-to-trough loss in the portfolio. Many investors can recall this property of high-yielding dividend stocks as recently as the 2008-2009 crisis, with many financials having seemingly high yields that were, in fact, not sustainable. Combining all 3 measures into one factor, shareholder yield, results in a substantial increase in absolute returns. The simple shareholder yield portfolio outperformed the S&P 500 by about 3 percentage points yearly, while a $10,000 portfolio investing in the S&P 500 in 1971 would have been worth approximately $1.7 million at the end of 2022. The portfolio investing in the highest quartile of shareholder yield stocks, what we'll call high shareholder yield going forward, would have been worth $6.7 million. Other investment companies have started to take notice of the shareholder yield factor. Here's JP Morgan on shareholder yield. The problem with dividend yield investing in the U.S. has been that dividends have gone out of favor with U.S. corporates. The correlation between free cash flow and dividend payments has diminished. Even companies that do pay dividends typically distribute a much lower percentage of their free cash flow than we see in other regions. Indeed, many U.S. companies consider a dividend yield of, say, 4% or more to be insulting. Buybacks, on the other hand, have been a better indicator of strong free cash flow. Across the range of definitions, we find the single best measure of value is arguably shareholder yield, which combines the effects of dividends, buybacks, and net issues, with the familiar price-to-earnings ratio coming in second. The shareholder yield portfolio is also consistent. While the high dividend yield portfolio outperformed the S&P 500 in 48% of all years, the high shareholder yield portfolio outperformed in 71%. Investors often want to try and understand when a particular strategy works best and when it might falter. After all, no strategy works all the time. If you compare the historical return of the shareholder yield strategy versus the overall market, there are a few data points that stick out. Since 1972, in positive years for the broad market, the market averaged a 20.69% return versus a 22.55% gain for the shareholder yield strategy. But in negative years, the broad market averaged a minus 11.91% return, almost twice as bad as the minus 6.87% return for the shareholder yield portfolio. In the big down years, defined as greater than minus 10%, the broad market averaged a pullback of minus 20.77%, again nearly double the minus 10.91% drawdown for the shareholder yield portfolio. The results make intuitive sense. A strategy like shareholder yield, which tilts towards value and quality, would be expected to do well in big bear markets. 2 of the best years for the strategy versus the overall market were 2000 and 2002 in the aftermath of the dot-com bubble burst. Meanwhile, What are two of the worst relative years for the strategy? You guessed it, 1998 and 1999. In Figure 16, we show an equity curve depicting all three portfolios from 1971 to 2022, the S&P 500, the high dividend portfolio, and the high shareholder yield portfolio. Now, can we improve results by focusing on dividend growth or by expanding the investment universe? Some investors prefer the concept of dividend growth to high dividend yield, and what's not to like? The name sounds like the best of both worlds. You get a reliable dividend stocks that are also growing too. We replicated the same screens but added a column for top dividend growth stocks. Many investors may be scratching their heads as they have likely seen some famous charts in the literature showing that dividend growth stocks outperform over time. However, these studies were based on faulty index construction but are still being published today. An entire generation of funds were sold on the faulty premise of dividend growth outperformance. Not sure if you believe this statement? Here's a great piece published by O'Shaughnessy, Dividend Yield versus Dividend Growth, that adds detail to the same conclusion. Dividend investors would do better by focusing on dividend yield rather than dividend growth. What about expanding the investable universe? If you decide to broaden your search to the top 3,000 stocks and only invest in the top 10% or 300 stocks, equal weighted, your return would increase to 14.94%. If you chose to add a value tilt to the portfolio, say, by eliminating the top half of the universe by PE ratios, you would increase returns and Sharpe ratios even further. In fact, it even works in expensive stocks. Below, in Figure 19, is a table that examines the top 1,000 stocks by market cap divided into the top 500 most expensive and the 500 cheapest stocks based on PE. It then invests in the top 100 stocks with the highest shareholder yield. And what you can see is returns for the top 1,000 stocks equal weight are 10.35%. The expensive shareholder yield is 13.38%, and the cheap shareholder yield is 14.9% per year. Look, there are countless permutations on constructing a final portfolio, but the conclusion remains the same. Focusing on shareholder yield has worked. One of the biggest tests for any strategy is out-of-sample performance. This can include real-time performance, as well as prior history that has not been examined. The best test, of course, is real-time, real money performance, net of all trading costs and fees. In the next chapter, we'll examine research on shareholder yield that goes back another 100 years. Chapter 8, a longer look, nearly 100 years of shareholder yield. Investigating any investment approach should produce results that work most places, most of the time. Nothing always works, but it would be concerning if a strategy only worked in one country or sector or market environment or time frame. For a longer analysis of combining cash flow metrics, we looked at one of the most comprehensive studies on classic quantitative factor screening in the Bible, the book by James O'Shaughnessy, What Works on Wall Street. There's a chapter on shareholder yield, but he doesn't include debt paydown, so under our definitions, it's net payout yield. He finds that high dividend yielding stocks outperform the crisp large stocks universe by 1.18 percentage points per year from 1928 to 2009, and then including net buybacks increased the returns by another 1.92 percentage points per annum. He also finds that more concentrated portfolios can add another 1 to 3 percentage points per year on top of this number. O'Shaughnessy finds that returns for the top decile of shareholder yield stocks were positive for every decade except the 1930s. Indeed, the excess returns over large stocks have been consistent and positive every decade since the 1930s. Not surprisingly, with the advent of the SEC Rule 10b-18 in 1982, 2 of the 3 decades with the largest excess returns were the 1980s and 2000s. Excess returns of shareholder yield above large stocks averaged 2.37% per annum from the 1930s through the 1970s, while the excess returns averaged 4.76% per annum from the 1980s through the 2000s. Pim van Vliet recently published the paper The Conservative Formula, Quantitative Investing Made Easy, and the companion very good book, High Return from Low Risk. The paper examines net payout yield paired with 2 more factors, low volatility and momentum, and finds similar results. From the largest 1,000 stocks, 500 with the lowest 3-year volatility are selected. From this subset, 100 stocks with the best net payout yield and price momentum are selected. The resulting equal-weighted portfolio is then rebalanced on a quarterly basis. The portfolio returned 15% per year from 1929 to 2022. But might U.S. data skew the results? After all, U.S. companies spend more on share buybacks as a percentage of earnings and market cap than other countries. Currently, the U.S. accounts for approximately 70% of global stock buybacks, according to Janice Henderson. From Janice, the rapid growth in buybacks is not a one-year phenomenon. Astonishingly, buybacks have almost tripled in value since 2012, easily outpacing the 54% increase in dividends over the same period. Every region, almost every country, and almost every sector have seen them grow strongly. The biggest jump came in 2018 and was mainly caused by U.S. technology companies ramping up their buyback programs. The consequence of this rapid growth is a significant increase in the importance of share buybacks. In 2012, globally, they were equal to just 52% of dividends, ranging from 3% in emerging markets to 102% in North America. In 2022, the global figure had jumped to 94%, ranging from 18% in emerging markets to 158% in North America. This trend to more buybacks in foreign markets should continue as more companies embrace the tax benefits of buybacks as companies have in the U.S. Another piece that covers buybacks and dividend investing in foreign equities is the importance of dividends and buybacks, ratios for gauging equity values, by our friend Jeremy Schwartz. Second, even with international companies buying back less stock than U.S. companies, this strategy still produces outperformance. Robeco also found similar results when evaluating European and Japanese markets since 1986, and when tested in emerging markets dating back to 1993, the strategy had performance of over 20% per year. Van Vliet makes a strong case for this simplicity and outperformance of this market approach. First, his chosen 3 factors, low return volatility, high net payout yield, and strong price momentum, don't even require accounting data. This makes implementation easy even for non-professional investors. Then the results speak for themselves. The methodology showed a positive return every decade since 1929. Furthermore, it outperforms the market by a healthy margin while reducing downside risk. Van Vliet concludes, this simple formula gives investors full and efficient exposure to the most important factor premiums, and thus effectively summarizes half a century of empirical asset pricing research into one easy-to-implement investing strategy. The returns are consistent over time across international stock markets and in U.S. small and mid-cap stocks. In sum, this simple formula can be used by active investors to profit directly from half a century of academic insights by applying one simple investing formula. While these are just a few extensions to the simple concept of shareholder yield, shareholderyield.com includes a literature review with links to many more pieces on various yield strategies that will provide fruitful ideas for constructing stock portfolios. Chapter 9. Shareholder Yield Across Sectors and Industries. Some analysts claim comparing stocks from various sectors is inaccurate due to their structural differences. However, Richard Tottoriello has also presented backtests in his book Quantitative Strategies for Achieving Alpha, demonstrating that shareholder yield portfolios would have generated alpha in all 10 U.S. equity sectors when examined independently. We decided to test the idea with more up-to-date information. The research project was inspired by a conversation with the portfolio manager who focused on gold stocks. Gold stocks have notoriously underperformed the metal, which has recently hit all-time highs. Many gold companies are huge cash incinerators, so you want to own the companies run by CEOs who are thoughtful about capital allocation and treat their shareholders kindly. It recalls what Mark Twain supposedly said, "A gold mine is a hole in the ground owned by a liar." We once again partner with our good friends at Alpha Architect, who constructed most of the backtests in this book to examine the results at a more granular level. And not surprisingly, it worked. The equal weight returns for the mining industry were 6.79% per year from 1974 to 2020. The high shareholder yield bucket was 11.61% per year. The middle bucket, 6.77%, and the low bucket, 0.64%. The mining sector returned 6.29% for market cap weight and 6.79% for equal weight. So, does shareholder yield work in other sectors and industries too? Across all 12 sectors, a high shareholder yield strategy results in average outperformance of 2.91% over buy and hold. For market cap weight, the result is similar but lower at 2.22%. The best part, it worked in all 12 sectors. What if we go a little more granular and reduce it to 30 industries? A warning here, as you move to smaller subsets, some of these groups would have had low stock numbers 50 years ago. It turned out it worked in all 30. The result was even more pronounced here, where we saw a 3.35% outperformance for equal weight and a 2.50% performance for market cap weighting. These results are not earth-shattering, but the confirmation of research in diverse sectors and industries instills confidence. Chapter 10. Why does Dividend brand persist? The Pepsi Challenge. Over a decade ago, we set out to educate investors on shareholder yield. And yet, despite our best efforts, investors are still in love with their dividends. In their recent report, Searching for Great Dividend Funds, Morningstar calculates 348 open-end mutual funds and ETFs with over $1 trillion invested focused on dividends. At a hypothetical 3% dividend yield, that $30 billion in cash dividends buys a lot of pina coladas. $1 trillion is a lot of money. Clearly, investors still love dividends. But given all the research and evidence that the shareholder yield concept is a superior methodology, why does the dividend approach persist? It's because dividends have a great brand. Old habits and narratives are hard to change. Here's an example. Beginning in the 1980s, Pepsi started running Take the Pepsi Challenge television commercials featuring taste tests that would pit their soda against Coca-Cola. Tasters would take sips of each unmarked beverage and be asked to declare which soda they preferred. Invariably, Pepsi was the favorite choice. Coke conducted its own trials and astonishingly found similar results. The off-cited reason was that Pepsi's formula was sweeter, and this led to the conclusion that Coke needed to change its formula, which resulted in the disastrous rollout of the abomination named New Coke. However, even though people blindly preferred Pepsi, they still bought Coke to the extent that it commanded a much larger share of the soda marketplace than Pepsi, and still does today. In tests, researchers also found that foreknowledge of the brand altered the results. People's responses changed, and the majority preferred Coke when they knew the brand. Why is this? Are people irrational, or are there other factors at play? Maybe childhood memories of drinking a Coke with Grandpa on the front porch swing? Or perhaps the warm, fuzzy feelings you have from watching the polar bear commercials and the Super Bowl. Regardless, the simple conclusion is that there is more at work than taste or even logic alone. Brand means something, which applies to other items such as wine, automobiles, and clothing. Do the same branding imprints impact investing and stocks? Certainly. For the old investors, think back to the E.F. Hutton commercials from the 1970s. When E.F. Hutton talks, people listen. Or Smith Barney. They made money the old-fashioned way. They earned it. For younger generations, the E-Trade baby commercials featuring a talking baby discussing investing became a cultural phenomenon in the early 2000s. There are also the great brands of Warren Buffett or Peter Lynch. The Pepsi Challenge can provide a metaphor for high-yielding dividend funds of late. Dividends also have a great story. You may have learned about them from your parents or taken an investing course in college. One could go as far as say, dividends have a great brand. Much like Coke, thoughts of dividend stocks immediately conjure images of regular checks coming in the mail from profitable, established companies. However, market valuations and stock and fund characteristics ebb and flow based on cycles and investor psychology. While it was nearly impossible to find someone wanting to invest in dividend stocks in the late 1990s, almost everyone was clamoring for dividend stocks in a desperate search for yield during the ZIRP environment. But a beloved brand shouldn't blind us to the realities of observable data. And those data suggest that dividend investing alone faces its challenges. So, with all the evidence presented in this book, Why do investors still invest in dividend funds when they could be investing in something else? Perhaps investors prefer the high dividend funds for the same reasons they prefer Coke. It feels familiar. Perhaps think back to being burned by non-dividend stocks in the 2000 tech bubble, or they recall talking to their parents around the kitchen table as a child. Making the best investment choices requires a separation of logic and emotions, which is very hard for most investors. After all, studies have shown that of all the things that get us emotional, our money is very high on the list. Chapter 11, Practical Implementation, Investing Using Shareholder Yield. If you've listened this far and agree with our thesis, you may be asking yourself, how can I screen for shareholder yield stocks? Is there a way to invest in shareholder yield portfolios? We've built a homepage that includes links to resources at www.shareholderyield.com. For those looking to implement a do-it-yourself shareholder yield approach to investing in stocks, a few additional resources are available to the investor. First, you have stock screeners. There are countless stock screening applications on the internet, ranging from somewhat limited free screeners to highly customizable professional screeners. There are too many websites to list here, but the investor needs to do their homework as the screeners have various levels of quality. Only a few sites have shareholder yield criteria as a preset screen that we can find, but here's a list of a few websites to get you started. Ned Davis Research, YCharts, Bloomberg, Portfolio 123, AAII, Morningstar, Vetify/ETF database. For those looking to allocate to shareholder yield funds, my company Cambria manages numerous shareholder yield strategies, and more information can be found at www.cambriafunds.com. Chapter 12, Summary. When a market experiences structural changes, it is important to adjust the investment approach in a way that reflects and effectively responds to those changes. As we detailed in this book, the investment market experienced such a structural change in 1982 with the SEC's Safe Harbor Rule 10b-18. Up to that point, dividends were perhaps the most hallowed of all stock market's sacred cows. However, even today, after vast mountains of new research have suggested that a shareholder yield approach to investing offers superior performance than dividend investing alone, many blind men can't see it. Instead, they cling tightly to their dividend gospel, either unwilling or unable to accept that the proverbial elephant has other characteristics. Returning to the blind man and the elephant from our introduction. So often theologic wars, the disputants, I ween, rail on in utter ignorance of what each other mean, and prate about an elephant not one of them has seen. We believe it is vital to evaluate all the different ways a company returns its cash flows to investors, and what that means for total returns, rather than focusing on dividend yields alone. In doing so, we hope to avoid the outcome of the blind men who each was partly in the right and all were in the wrong. Here's a summary of the findings outlined in this book. Dividends and their reinvestment contribute a major portion of the stock market's total return over time. Portfolios that invested in high-yielding dividend stocks have outperformed low-yielding portfolios and broad market indices in the U.S. and in foreign markets. Dividends are only one use of a company's cash flow. Other uses include stock buybacks, debt paydown, acquisitions, and reinvestment in the company. Due to tax treatment and structural changes in the 1980s, U.S. companies have shifted their payout mix to include more stock buybacks. Accounting for other ways companies return cash to shareholders is vital to assessing a stock's attractiveness. Portfolios that invested in stocks with a more holistic cash flow distribution focus, such as high shareholder yield, have experienced a higher total return than dividend yield portfolios or the broad stock market. Thank you for listening to this audiobook of Shareholder Yield, A Better Approach to Dividend Investing, 2nd edition. You can find more information, including downloadable figures in PDF, at www.shareholderyield.com. You can find investing research on my blog at mebfaber.com, our investing podcast, The Meb Faber Show, as well as information on investing offerings at cambriainvestments.com, as well as cambriafunds.com. Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast.
If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.